Why are home prices going to decline 20% this year?
Because of excess inventories. We estimate that there are 2 million inventories, both visible and shadow inventories, over and above normal working levels. And that's a lot. Back in the normal times, we build about 1.5 million houses a year, so 2.5 million is a tremendous overhang. And excess inventories are the mortal enemy of prices. Now, I think what may happen here is that now that the robo-signing flap is settled and the servicers, the big banks, settled for $25 billion with the various state attorneys general and the federal government, they've been holding off on foreclosures because they had enough bad PR. Now they've settled that. I think they're going to go back to foreclosures. And the National Association of Realtors says that when foreclosed houses are sold, they sell at a discount of 19% to existing houses, and that drags everything down when you get a big dumping of these houses on the market. So I'm looking for another 20% decline, and that's what it would take to bring them back to the long-term averages that go back to 1890 in terms of median single-family house prices.
Wow, Mark, how do you factor in those inventory levels?
Well, currently we have 2.5 million homes in existing inventories. That's down in the last 7 years from 4 million. There's only 144,000 new homes for sale. That's at a 49-year low. Existing inventory is at a 7-year low. And if you look at the shadow inventory, there were 3.6 million homes 90 days plus delinquent 2 years ago. Today there's only 2.9. So basically all inventories you look at, whether new, existing, or shadow, they're all coming down.
Well, although they're coming down, but they're still huge. I think it's a point. I mean, we had a graph of that showing that. I think we can pull that up again. And yeah, they're down, but when you count in the shadow, and particularly this category the Census Bureau has, which are houses held off the market for other reasons, very descriptive, but it includes foreclosed houses that are vacant but not yet sold. It includes houses that people listed but they couldn't stomach the bids they got, so they pulled them off the market. And you count all that in, and you're still over a usual working inventory of about 2.5 million. You're still 2 million over above that when you count everything in.
Well, the exact number, and Mark, I'd be curious to know what number you're looking at, because the one that we track here at Bloomberg is the one that Gary's following, which comes in at about 3.9 million units, and you're suggesting it's quite a bit lower than that. What's your thought on the discrepancy?
Yeah, what I was quoting is the 90-day plus delinquency. So if you add that plus the foreclosures, you get to the 3.9 level. The thing about housing is it's very much a regional market, and the homes that your viewers and people actually would want to buy, you need to look at the existing inventory that's quality. Go out and look for a house now. There's less quality inventory on the market today than there were a year ago. That shadow inventory, I think, will get absorbed quicker than you think. And the reason is that the implied rental yields are roughly 5 to 12% in a lot of markets. And so investors are going to line up. And quite frankly, Gary, I respect all your work and I've read a lot of your books. But if housing really does go down 20%, I'm going to back up the truck, and likely PIMCO will too.
Well, that's right, because at that point the percentage underwater of mortgages would go from now 23% to our estimate is 40%. The equity of people who have mortgages, which has come from almost 50% in the early 80s to 17%, would go down to about 7%. Virtually nobody with a mortgage would have any equity. And what that would do to consumer spending, to say nothing to mortgages and mortgage-backed securities derivatives, I mean, that's pretty heavy-duty stuff. That's recessionary kind of things, and we think that that'll probably happen over the next 3 or 4 years, one way or the other.